Recently, Bloomberg reported that China sold a record amount of U.S. Treasury and agency bonds in the first quarter. This move is part of China's strategy to diversify away from American assets amid ongoing trade tensions and to increase its gold reserves. According to U.S. Treasury data cited by Bloomberg, Beijing sold $53.3 billion worth of U.S. Treasury and agency bonds from its stockpile. Belgium, which often acts as a custodian of China's holdings, also disposed of $22 billion of treasuries during this period, reducing its total holdings to $775 billion. Despite U.S. Treasury Secretary Janet Yellen discussing the matter with her Chinese counterparts during an official visit to Beijing, Alicia Garcia Herrero, chief economist for Asia-Pacific at Natixis, believes further sell-offs are possible. She remarked, "I think the moment she mentioned that the U.S. wouldn't take anything off the table in response to China's overcapacity, Beijing wanted to signal their seriousness about dumping us treasuries." Before I continue, please consider liking the video and sharing your views in the comments section below. Your feedback is invaluable to us and our global audience. The critical question here is, who will continue funding the federal government's borrowing spree? Although China remains the second largest foreign holder of U.S. debt with $775 billion, the UK, holding $700.8 billion in U.S. treasuries, could soon overtake China. Japan is currently the largest foreign U.S. creditor, with $1.17 trillion in treasuries. China has been reducing its US debt holdings for several years, falling from around $1.1 trillion in 2021 to the current $775 billion. One estimate suggests that China has sold more than $300 billion in U.S. treasuries from 2021 to the first quarter of 2021 to the first quarter of 2024. Stephen Chiu, chief Asia foreign exchange and rate strategist at Bloomberg Intelligence, stated, "As China sells both U.S. Treasury and agency bonds, despite us nearing a Fed rate cut cycle, there is a clear intention to diversify away from US dollar holdings." He added that China's selling of US securities could accelerate, especially if the US-China trade war resumes under a potential Trump presidency. Renmin University finance professor Zhao Shijun told the South China Morning Post that the sell-off is likely to continue. He said, "China's overseas investment has been heavily concentrated in US treasuries in the past, but there is room for the Chinese government to further reduce its holdings in the future."
China is intentionally minimizing its exposure to the dollar. Chinese policymakers have noted how the United States weaponized the dollar against Russia, including how Janet Yellen floated the idea of seizing Russia's frozen dollar-denominated assets and giving them to Ukraine. The Chinese are closely monitoring these actions, understanding that the U.S. could use the dollar against China during a conflict. As a result, China appears to be accelerating its de-dollarization efforts, especially as trade relations with the U.S. show little sign of improvement. Recently, the Biden administration announced tariffs on a range of advanced Chinese products, from electric vehicles to batteries. Former President Donald Trump, if re-elected, has promised to impose tariffs as high as 60% on Chinese imports. As part of its broader strategy to diversify global finance, China is also reducing its dollar reserves and increasing its gold purchases. Gold now constitutes 4.9% of Chinese reserves, the highest level since 2015. This trend is echoed by other central banks, which have been buying gold at record rates. The pattern of increasing gold reserves among central banks began after witnessing the West impose dollar restrictions on Russia in 2022. Concerns over U.S. sanctions first triggered this behavior, particularly among countries like China and Russia. These countries have been boosting their gold holdings and using local currencies for international payments since 2015, while countries allied with the U.S. have maintained stable gold reserves. Geeta Gopinath, the first deputy managing director of the International Monetary Fund, noted, "This suggests that gold purchases by some central banks may have been driven by concerns about sanctions risk." China is stockpiling gold, a reserve asset with no counterparty risk. The People's Bank of China has added gold to its reserves for 16 consecutive months, accumulating over 300 tons of gold since it resumed reporting purchases in October 2022. China may hold far more gold than it officially reports. As Jim Rickards noted on Mises Daily back in 2015, many analysts believe China keeps several thousand tons of gold off the books in a separate entity called the State Administration for Foreign Exchange SAFE. This raises the question, how significant a problem is this for the U.S. Treasury and the United States? If China and other countries continue to dump us treasuries, it will create a substantial gap in the market, as the federal government consistently runs massive deficits. Foreign investors constitute about 1/3 of the market for U.S. treasuries. While there might be significant capacity in the domestic market, the issue is that the largest domestic U.S. bondholder, the Federal Reserve, is also pulling back. By the end of 2022, the Fed owned 35% of all domestically held treasuries, totaling over $6 trillion. The Fed typically holds agency bonds and exerts considerable influence on the bond market. By purchasing and holding U.S. bonds, the central bank creates artificial demand, driving prices higher and keeping yields lower than they would be otherwise. This manipulation allows the U.S. government to borrow more at lower interest rates than it could in a free market. The real issue is that the Fed is currently out of the market and aims to let Treasuries roll off its balance sheet as part of its tightening policy to curb price inflation. However, if both the largest player in the domestic Treasury market, the Fed, and the second largest player in the foreign Treasury market, China, are selling bonds, who will absorb these bonds along with the new debt issued by the U.S. Treasury each month? This dynamic is one of the reasons Treasury yields continue to climb, despite hopes for a Federal Reserve rate cut. This poses a significant problem, as the U.S. government has already spent $522.02 billion on interest payments just halfway through fiscal 2024, a 35.9% increase over the same period in 2023. The only spending category higher than this is Social Security. If the Fed decides to re-enter the Treasury market, it could end up being inflationary for the United States. Please don't forget to like this video, subscribe to our channel, and press the bell icon for new videos on important international topics. Thank you for watching.